Good day and welcome. My name is Eugene Botha and I'm the Deputy Chief Investment Officer at Momentum Investments. Joining me today is Jako Jager, our Head of Retail Portfolio Solutions. What we would like to share with you today is a very interesting concept as we look into the future. Now, before I delve into a bit of the detail, I quickly want to reflect on the evolution of technology. If we cast our minds back 20 odd years ago, there was a television program called Beyond 2000. Now, we were mesmerized by the technology and technological advancements showcased on this program. Anything from hoverboards to self-driving cars, let alone flying cars like we have today. Now, youngsters are racing around on hoverboards today, as we know it, and the research aligned to space travel has moved on to space travel for a 10-minute fun ride, similar to what we experience in an amusement park, obviously for those who can afford it. The future we once imagined impossible is here now. The pace of change is increasing and the impact far-reaching, both from a social as well as from an economical perspective. Now, technology and technological advancement is no longer a buzzword or a nice to have, as we are currently experiencing the fourth industrial revolution, a phrase coined by Klaus Schwab in 2016. Now, a quote by Joe Kaiser also suggests that the fourth industrial revolution is not just about the economy, businesses, and profits, but it also has a massive impact on the environment as well as on society. Now, COVID-19 has made us realize that the world is changing. For us, as investors and custodians of assets, we realize that we are in a very unique environment. This unique environment poses lots of exciting opportunities for us to grow our clients' assets and their wealth. But at the same time, it comes with a huge responsibility in terms of how those assets are deployed, as well as the impact that has on society, on the environment, as well as on the economy. The world is changing, and alongside all, the ecosystem. We are facing an increasingly complex, connected, and changing world. At the same time, while unprecedented digital innovation is disrupting the value chain. We need to be sure that whatever it is that we are approaching and the way that we try and evolve in this world is done for the right reasons. We're also facing human as well as climate challenges, while at the same time we're trying to build the world of tomorrow for future generations. So Jako, how does that strike you?
Thank you very much, Eugene. We are indeed living in exciting and extraordinary times. Of course, innovation has come a long way. We've seen the introduction of the steam engine that catapulted or translated into the first industrial revolution many years ago. That was followed by electricity, electronics, and other innovations that people could only dream about. Now they seem like ordinary things. Of course, for us, where we stand today, we need to take cognizance of these changes. And we know that the pace of change has accelerated greatly. Today, we're looking at economic changes. We're looking at disruptive technologies, societal changes. And all these factors are combining into a very interesting investment landscape. They offer investment opportunities. And it's our duty to look forward in terms of how we introduce those into the investment sphere. Now, of course, there are themes like globalization. We're looking at societal changes, demographic changes, urbanization, even blockchain. These are all phrases and developments that we have to take cognizance of. These are some of these phrases weren't talked about many years ago, but now they are at the forefront of what we need to think about. So from that perspective, it's time for us to step up. It's time for us to introduce these themes and these opportunities in the portfolios that we manage. Now, what is thematic investing? And how do we define this investment process or this opportunity set? Well, first and foremost, is it a fad or is it just a flavor of the month? And we actually disagree. We think these are long-term trends. These are trends that will play out over time. They're grounded in investment theory, economic development. And it's important for us to be able to demonstrate and identify these trends before they run their course. Now, of course, not all trends are the same. Some are, or the vast majority, would be a longer term in nature. These are trends that would take 7 to 10 years to play out. Whereas you may also find that there are trends that are perhaps a little bit shorter term in nature. These are ones that are grounded in shorter term anomalies and things that will, through their life cycle, play out a little bit quicker. So from that perspective, I guess the catchphrase is, or at least the idea that we need to bring home is that these are long-term investments. We need to focus on macroeconomic evolutionary themes. We need to understand how these global trends and shifts will affect the world. We talk about ESG. What is ESG? It talks about environmental, social, and governance frameworks. And we believe that this will shape the way that companies do business, changes the way that they look at the environment. Do they conduct themselves in a socially responsible way? And what happens behind those boardroom doors? How's the governance framework? Do they do the right thing? That's one theme, one example of a theme that we need to take into cognizance. We're talking about the race to a zero carbon economy or zero carbon events. These are all things that probably weren't discussed in depth, say, 5 or 10 years ago. Now, again, that tells you that these are longer term themes. You need to have a longer term investment horizon to capitalize on them. And that will see your capital grow over time. Of course, it's a little bit different from just trying to identify, call it company fundamentals, and trying to find the best valuation argument. So, of course, there are some differences, but we'll talk about that a little bit later on. If we think about the investment landscape, how it's changed, I guess you can see that it's been quite significant. BNP Paribas did an analysis some time ago that showed that this trend actually started back in the global financial crisis in 2008. So it's been a very gradual yet deliberate movement of assets from what you would sometimes term to be more traditional investment approaches, whether it's a focus on certain asset classes, investment styles, or even philosophies. Investors have moved on, and they've started introducing these thematic exposures in their portfolios. As you can see as well, that exposure has grown over time, moving from 1.5% in 2011 to over 2% in portfolios as we stand today. At the same time, the assets allocated to these strategies have grown exponentially, more than 3.5 times what it was in 2015. At the same time, we sport for choice. If you think about the investment vehicles and the execution on these strategies, we have more than 1,100 funds to choose from. So again, you can see this is where the world is going. And from an investment perspective, it's something that we can't neglect. And it's something we can capitalize from. So how does it differ? How does thematic investing either work against or with traditional investment? We firmly believe that it's different sides of the same coin. Why do I say that? It's because in a similar way, active and passive investment were questioned previously, but now it's taken as almost as a gospel that the combination of these investment strategies can give you a better risk-return outcome. Looking at it in a similar way, we see traditional and thematic investing working exactly the same way. There are some subtle differences, as I mentioned, where traditional investment is put forward as a medium to a longer-term investment. Thematic investing is, of course, a much longer-term outlook, as I mentioned. What that means from a practical perspective is that traditional investing tends to have a shorter cycle. And why I say that is because investment managers tend to report back on performance on a shorter-term framework. So therefore, from a portfolio management perspective also, positions are taken relative to a market index. So it's either expressing your view via an over or underweight exposure to certain counters or stocks, where thematic investing is more absolute in nature. There, as I mentioned, we look at the longer term. We're looking at the trends that will play out in the years to come. So there are some subtle differences. At the same time, again, going back to a market-linked index, you'll find that thematic indices or thematic investments tend to have a much higher tracking error or deviation from a traditional benchmark. And therefore, one shouldn't be surprised when you see performances deviate significantly from these market indices. Again, you can see how the differences play out on the slide. But again, these are complementary. And therefore, it's important from an investment management perspective to combine these in a holistic way, in a way that makes sense for portfolios and clients alike. Eugene, why don't you take us further?
Thanks, Jako. So our thematic investing approach offers an alternative to your traditional strategies, looking for sources of growth and performance through long-lasting trends, offering sustainable and transparent solutions for our clients. Now, we believe that including a thematic strategy on an asset class level represents the highest commitment as well as the least constrained allocation to such a strategy, as opposed to having a tilt towards a specific strategy or theme in a portfolio, or having a tilt or an overlay on a portfolio. We believe that having that dedicated exposure to that strategy will reap the most benefits for our clients. Now, diversification, as per usual, is key in how we build portfolios and how we include this thematic fund in our multi-asset solutions. Risk management obviously plays an important role, and the conviction and exposure to certain risks and themes should be aligned to the overall client objective and goal that we are solving for. We believe that a thematic fund based on outcomes-based investing principles is the approach to follow, as it is aligned to the overall objective for that client, and it's very much goal-orientated as a result. We believe that from a fundamental perspective, we should diversify across a couple of different themes to ensure that there's no specific sector or stock or geographical risk in the portfolio. We believe that there are 6 main themes that we have identified that will shape this evolutionary world. These 6 themes are climate change, technological innovation, demographic change, space exploration, the shifting economic power from the east to the west, as well as lifestyle. Now, according to some research from BNP Paribas, most of the investors that are looking for thematic investing ideas or themes, about 75% of them are focused on sustainability and ESG solutions. Of that 76%, about 41% are looking to gain exposure to themes that are defined by the United Nations Sustainable Development Goals, or SDGs in short. About 21% of that focus is on climate change, and another 18% to renewable energy. It is therefore not surprising to understand that the global economy and how the world will unfold over time will be aligned to these SDG goals. From our perspective, we also believe, therefore, that our themes that we have identified is aligned to the sustainable goals over the longer term. And it's therefore not surprising in terms of the way we invest, in terms of how we actually want to shape and unfold the world for future generations. Thanks. Jako, can you give us an idea of how the fund is actually managed?
Let's make it practical. How will we manage this portfolio going forward? Well, as you will see, first and foremost, we see this as an actively managed solution. You may ask why active or actively managed when these themes take so long to play out. Why not set and forget? But we don't believe in that approach. We believe that, again, from a portfolio management perspective, similar to any other approach, the best approach would be to be actively involved in both the identification as well as the construct of this portfolio. Seeing as this is will be a multi-strategy portfolio that combines various themes or strategies in a single solution, we need to keep our finger on the pulse. We need to understand how these themes work, how they play out, and also how they react relative to one another. Very importantly, from a portfolio construction perspective, we also need to manage any concentration risk, assuming there is some, as well as overlap between themes and portfolios. So again, it does not allow itself to be a passively executed fund. I think at the same time, very importantly, as we move into this area of cost control and cost management, it's important for us to also take cognizance of that. And the way we execute will continue to be with that in mind. And it's for that reason that we basically scour the globe for the best execution, whether it's through exchange-traded funds, notes, or even other instruments. But ultimately, the objective is the same. If we look at how these various strategies react and perform relative to one another, it's clear to see that they sometimes have a life of their own. What that means is that some strategies, we believe, have different durations and different attributes. The drawdowns may be different, and so too the expected returns. So from that perspective, again, bringing all these together in a harmonious way means that the blend is ultimately your friend. So again, from the way that we manage it, and that we will manage it proactively going forward, is to make sure that we have the right balance within the portfolios. Again, as we mentioned previously, it's important for us to also measure this portfolio over a relevant time frame. So whether it's rolling 5 or 7 years, that has to be the cornerstone through which we monitor and view the solution. Again, we may monitor and report on this versus market cap indices over the shorter term, just to give a sense for how these portfolios are playing out. But ultimately, the expectation should be that this would be a more aggressive solution, one that has, and from time to time may have, a bigger deviation from your traditional market indices. Very important, of course, therefore, is how we look at portfolio construction. How do we bring this together into a one portfolio? And with that, I'm going to hand over to Eugene.
So apart from identifying those mega trends, the second most important concept of thematic investing is portfolio construction. You can either construct a portfolio in a diversified sense, having exposure to a diverse set of different themes, lowering the risk of one specific theme not playing out, or you can have exposure to one specific theme where the potential profits from that theme is potentially higher, but there's also a risk of it failing if that theme does not play out. Another important concept of thematic investing is information. Now, there's lots of information out there that is quite difficult to digest. But with machine learning techniques and big data, we can get through all of this data and make sense of it a lot quicker. Now, it's information like your life cycle of the theme, the duration, the catalyst of growth, and even the emergence of other competition in the market that is important to understand to get to a point where you can actually make informed investment decisions and introduce the right themes into the portfolio as a whole. Diversification is obviously key. And that is also, as I've mentioned earlier, the cornerstone of an outcomes-based investing approach. Risk management alongside that is important, and the amount of risk and concentration and conviction that you want to introduce into a specific theme should be based on the overall client risk profile and the goals you are intended to deliver on. How do we use this portfolio in a multi-asset class solution? So we believe that a thematic fund is complementary to the traditional asset classes in a portfolio. If we look at the global component of a solution, for example, there's a core component of traditional assets, and this thematic fund fits nicely as a complementary solution alongside that. Also, as I've mentioned earlier, the amount of exposure that you have to this thematic fund all depends on the risk profile and what you intend to deliver on over the longer term. So, what have we learned? So looking at the future, there's a couple of unique opportunities to invest into if we as investors are willing to take a different approach and look at the bigger picture. Now, thematic investing has got some challenges, and it's not as easy as it sounds to go and isolate and select certain themes. We need to understand what the structural drivers of the market is that will fit into these specific themes, as well as the duration in terms of how these themes will play out. Now, successful thematic investors do not need to be clairvoyant, but an understanding of what the future holds does form part of the investment strategy. At the same time, we can understand that certain themes that are stable and doing well today might tumble tomorrow. So therefore, humbleness through this investment journey is also extremely important. So thematic investing creates a unique investment opportunity to not only grow our assets and our wealth, but it also gives us an opportunity to fund the way that the future will unfold. We as humans need to evolve to ensure that we do not become the next dinosaur. Thank you very much for your time. Goodbye and stay safe.